All right, and Tricia's going to want to say it today. Thank you.
Okay, make sure, Lori was hearing some comment about keeping business and personal expenses together. We want to make sure we separate those things. So when you're keeping track of those, make sure you're keeping your Schedule F, your farming expenses, completely separate from your personal expenses. Okay, let's go into home office expense. For some of our farmers, this works out. For other ones, we're not able to use it. What this means is where you're receiving your bills, keeping track of your expenses, stuff like that. The main qualifier for this is it's got to be a dedicated home office. It can't just be a kitchen table that we have a laptop on and then we're typing on there. It's got to be dedicated home office, a small room, stuff like that, and then we can start to apportion some of our, say, real estate taxes, property or mortgage interest, utility bills, all this different stuff attributable to the home office, and take that as additional expense to our Schedule F. So who thinks they got a dedicated home office right now that they actually use to keep track of their expenses? Okay. You want to describe yours?
It has desktop, a laptop, 3 printers, trailer.
And you don't share, is this in a room or, and you don't share this room with anything else? Okay, so that qualifies. So really then all we need is the square footage of that room, the total square footage of your house. So say your room is 100 square feet, your house is 1,000. So now we're taking all your property tax and mortgage interest and taking 10% of that and allocating it to the Schedule F. The biggest thing that this gives us is if we don't itemize, say if you're a single person and you're under 65, 6,100, say those two things and state withholding and charitable contributions don't amount to 6,100. Well, then we've lost all this expense. What this home office gives us is now we can take it off the Schedule F, so it helps us on the Fed and it also helps us on the state. So if you have a dedicated home office, you got to keep track of more bills than most people do. And then the additional thing is depreciation of your home. Home office gives us a chance possibly to depreciate your house. So we also need the cost of the home and then what the land is underneath, what that's sort of appraised at.
Plus the improvements.
Plus the improvements, right. But this year, for 2013, the IRS came out with a sort of a simplified method. A safe harbor method is what they call it. We sort of get a double up on some of our expenses. So say your home office was 100 square feet. The IRS now says instead of keeping track of your utilities, your repairs, your rent possibly, property tax, mortgage interest, we just say $5 per square foot up to 300 square feet. So if it's 100 square foot, we get $500 just for that. Plus, we get the whole deduction of the property tax, mortgage interest on the Schedule A as well. Where before, we're taking, say, $1,000 for real estate taxes. On the home office, we're taking off 10%. So now we're down to $900. Only that $900 now counts on the Schedule A. If we do the safe harbor methods, we get to take the full $5, plus we get to use the whole property tax and mortgage interest on the Schedule A. So I think I found a couple people that we actually made money on the safe harbor. But then if you have a lot of utilities, this isn't even close. That $5 isn't even close to what a lot of people's utilities bills are.
Now, if you have just one big room, a lot of houses today have more open air type of structure. They don't have to have defined walls in them. If you can define the area by using filing cabinets and stuff, and actually say there's a room that's say 20 by 10, and out of that you have a defined area in that big room of say half of that, then we can take the square footage of that half and then use that as the allocation factor. It has to be either a room or a defined area, and so that can work also.
Well, I've got a defined area. With a defined area, you don't have to have a square feet.
Well, you take the square footage of that defined area.
Most of the
But it has to be like Andy was was saying before, it can't be like a desk in the bedroom. It can't be a kitchen table. It has to be a defined, if you got a desk with a computer, or you don't have to have a computer, but a defined area where your office activities are done. If you give us that square footage of that defined area, we can use that. Okay?
Now, dedicated, does that mean I only use that computer for business stuff?
Well,
Because I have office space.
what it means is, it's just for, it's sort of maintained as an office space. What we mean by dedicated is that there's not a desk here, and then you have, say, treadmill and weight systems over there. That's not dedicated. That's a workout space and an office space.
So I wouldn't have to buy another computer just to...
No. Oh, no. And it doesn't matter if you're playing games on there, or it's just to make sure that you're actually doing business activities. So you're writing out bills, keeping track of your bills, income, that type of stuff.
But they don't want it where you have the file cabinet in one room, you have the computer in a different room, and then we deduct the whole house.
Right.
That doesn't make sense. Okay, you can see what they're shooting. They're saying, if you're going to have an office, have an office. And then we'll give you the square footage for that office. But you can't be all over the house and spend hundreds of the house.
Ours is one area.
Exactly. Exactly. That's what
I mean, really, for small farmers, that would be totally takeable. And now we get some of our bigger farmers where they actually have an office.
Oh, yeah.
They built a shed with an actual farm office out there. Yeah.
Do you have to have a separate Schedule S for different farms?
It really depends on how it's sort of structured.
One in Florida, one in...
Now, you have two, because you have one in Florida and you have one.
I have one office in each one, and all that stuff too?
Well, if it isn't your personal residence, you may want that office at. So you have to be a resident of one state or the other. You
Okay.
can't be a dual.
I can't have an office here in home office.
Well,
Two offices.
yeah, you're.
Okay.
We've come to enjoy that with you so far.
On our piece of paper, if anyone calls with Daryl's name,
Watch out for the
Been there, done that.
too much liability.
I've been ordering twice. I ain't scared.
That's a write-off if you don't itemize.
Yes.
Yeah. Oh, it's
If you
great.
itemize, you can.
Well, if you itemize, no, you can definitely still take it. It's just that we're only then taking the unused portion of, say, property taxes and mortgage interest that we didn't use in that home office, and then that goes onto your Schedule A. That's what you're actually itemizing.
See, when you don't itemize, they give you a standard deduction. If your person's over 65, both people are over 65, it's $14,600. If you're under, both of you are under 65, they give you $12,200. Now you get that whether you got $1 or you got $12,199. So the idea is, if you don't itemize, you're going to get $12,200 regardless.
No, if I do itemize.
Unless you do itemize, then you get the extra. But I always, people always say, well, you're going to lose your deductions and stuff like that. If they'll give me $12,200 and I can take part of it over here someplace else, I get the $12,200 plus this. If I'm close, then I'm better off to go ahead and take this portion over here against the farm, because in addition to what the expenses Andy's talking about, you get the insurance and any repairs done to that office. Or if you put a new roof on, you can take that 10%, that percentage of that roof off. And there isn't any place else that you can do that.
But what you're also looking at is when we use a home office, that goes on the F. So page 1 of the 1040. So not only are we using it on the federal return, we're getting 5% on the state.
And 15% on something.
Yeah. I mean, when you're using your Schedule A, doesn't matter if you got 30,000 on your Schedule A. Doesn't matter if you got 6,100 on your Schedule A. Illinois doesn't give a crap. They don't see that part. But if we stick it on that F, then we translate over to the Illinois. So we get credit more for it on using it as home office. Then like he's saying, now our next subject is SE tax, self-employment tax. When you got normal W-2s, you're seeing that they're taking out Medicare and Social Security wages. Well, if you're sweating for your Schedule F income, as most Schedule F people are, you gotta be, then now we got to take 15.3% you're going to pay in addition to what you're getting taxed at ordinary rate. So say you're in 10% tax bracket. So we got 10% land, but you had a profit of over $434 on your Schedule F. Now we got SE tax on this. So yes, it's good that you're paying in Social Security. So eventually when you do decide to start drawing, you are going to have some benefits in there. But a lot of our people don't see it that way. They see it as, holy crap, now I got to pay 15.3%. And it doesn't matter if you have no taxable income. You can have, say $20,000 profit, and then all your Schedule A comes in and overcompensates for that $20,000. The SE tax totally goes off that net off that farm, Schedule C, partnerships, that type of stuff. So you could have no tax at all, and this freaking number comes in. Now you're going to have some tax. But I mean, SE tax, what you're paying for, 6.2% for Social Security, 1.45 for Medicare. And then we double that up because now you're the employer and the employee. To where if you're on W-2, you're just paying half of that. But now you're employer and employee, so that's how we get 15.3% on this.
They do give us a little deduction on page 1 of half of that Social Security tax they're paying, that extra, they let you deduct it. So the effective yield gets down to a rough, a little over 14%, but you're paying a lot more for earned income tax or self-employment tax than you would have if you was working for somebody else. Because again, the employer pays half, the employee pays half. If self-employed, you're paying the 15.3, they give you a little deduction off, but you're still paying around 14 cents. So.
And you're only going to get back what the employee side is.
Well, you look at, if you're in a 25% tax bracket, plus 14%, or say 15, go with the growth number, 15 for the self-employment tax, so 45, 15, and then plus 5% for state. Now we're looking at 45% every dollar coming out of that. You begin to wonder,
While working.
While working. I would say, I wouldn't mind it so much if Uncle Sam would pull a third of the weeds, but he wants a third of the take and he don't pull a damn weed. I said, that's a lousy part. That's the whole deal.
Did you just say, if you have your own business like a farm, whatever, and you're not working, you don't have the W-2s, but you're doing your own business and self-employed, you're paying 45% in taxes?
No. Everything is dependent on what you make.
Yeah.
I mean, if you're making, say your net off your Schedule F, so just your farm business is, say, $20,000 and you're a single person. So we take off $10,000 between your exemption and standard deduction. So now we're at $10,000 now is your taxable income. Well, heck, that's a little bit into 15%. But over the majority of that money, you're going to be paying 10% money. He's talking that person was in a 25%. I mean, you got to see that the federal tax is progressive tax. So as you make more money, your taxable rate gets higher and higher up to a limit of 39.6%. But I mean, if we're not making a heck of a lot of money, then no, it won't be 45%. It'll be 10, 15, 5. So, but SC tax, heck, 15%, that's a heck of a lot.
A lot of our farmers and a lot of our self-employed people, they pay more self-employment tax than they pay income tax. Because same like Danny was saying, if you take that $10,000, about the first $9,000 is taxed at 10 cents on the dollar. So you have about $1,000 in tax. But you pay, if you have a $20,000 net, you're going to pay about $3,000 in self-employment tax. So $3,000 versus and $1,000 coming for that, and 5% on the would be about $18,000, be about $900 state income tax. So you got $900 state income tax. You got $1,000 for federal income tax, but you got $3,000 in self-employment tax. That's a big number. That's a big number.
What if one is actually working part-time and also self-employed for that?
It doesn't matter. If you're not above, the main portion of SC tax is the Social Security. So if your other income is over $113,700, then we don't have to pay any more Social Security tax. But the employer side still does. So we're taking out 6.2, but I mean that's still a big number. But you got to be over $113,700 for 2013 in order to get rid of that portion of Social Security tax.
So if you've got $10,000 of W-2, and then you've got, say, another $10,000 of self-employed income, you're going to pay, on that $10,000, you're going to pay about $1,500 of self-employment tax. So, like Andy said, you got to get over that. They have a max, they shut off the old age benefits as far as what you're paying in, at like a 113.7. But anything that's below that number, you're going to pay self-employment tax on that, whatever that business net. So that's why the deduction going for on the Schedule F and Schedule C is a lot more important to you than it is on Schedule A. Because they're not only saving the income tax, but we're also saving the supplemental tax.
Yeah, they think in 4 to 5 years is going to be about 145 to 150,000 for that limit. Well, they got the baby boomers right now. My age people, there's not as many of us working, so they're not contributing to Social Security. So we're not sticking more money in when the baby boomers are starting to suck that off. So that's why they keep raising these limits. Yeah, that's why they keep raising these limits. So more money is being paid into Social Security, so we don't have such a big deficit for Social Security. Yeah. No, it's scary. What?
I said, we need you guys.
Yeah, but what are they gonna have Social Security they don't?
Well, who knows? But that's...
Well, a few years ago, they started on the Medicare. They started, if you made over 80,000, you were single, they took you from paying the normal rate, they doubled it for the Medicare. That was the means test. And the problem's going to be down the line, that was the AARP didn't sit up there and complain. I said, they got to be nuts not to be complaining about this, because everybody pays in, and the guy that makes the most probably paid in the most. And yet you're saying because you saved your money down the line, you're going to get penalized because you don't deserve it. Well, that don't look like a right tax. And they used to throw tea in the harbor in Boston over crap like that, and somebody ought to be complaining, but nobody's complaining.
But that also brings in a whole different subject is, if for my age group, there really is some young people in here, for my age group, we don't know if Social Security will be around for us. But what SE income, anything that drives SE income, we can do like certain IRA, Roth IRA, traditional IRA contributions, as long as we have earned income, that type of stuff. But, if we don't think that Social Security is going to be around, you got to plan for retirement somewhere.
Yeah,
So having it in a Roth or a traditional, that is...
If they would take a regular IRA, and see, right now it doesn't affect the deduction or what you pay on self-employment tax isn't reduced by the amount that you put into these plans. They take that off the income tax, but they don't take it off the self-employment tax. If they would at least make that change where you can deduct that, then that would help as far as that. But again, there's less money going into the coffers, so then they're going to have to raise that. It's like a dog chasing its tail, because you've got to get the money. And so if they make more deductions coming off against there, you're going to have less money coming into the pipe. And like he says, us more, I don't call it older, more seasoned people, we were going to be taking money out of this. You can't take something from nothing.
Right. Nothing from nothing.
But do you remember when I was talking to you about income averaging? The income averaging will affect your tax. It has nothing to do with your SE tax. So we can bring it back, say you had low years in the past 3 years. We can bring your tax down, but your SE tax is still going to go off the profit of the current business.
How do you get around paying SC tax?
Have a loss.
3 out of 5 years,
Keep
right?
a track, that's why any deductions you don't keep track of. At the end of the year, like I say, depending on what bracket you're in, but take at least 15, 25 cents, throw it in the ground and walk away from it, because that's what you've just done by not keeping track of it down. That's why it might sound like it's just paperwork, and my dad used to always say, you hate paperwork, but to be successful in business, if you're going to spend $1, you always remember 25 cents of that you can get back at the end if you turn it in, but you got to turn it in. If you don't keep track, that's 25 cents. You throw it on the ground and walk away from it. I always tell people, don't stop too short. It'll be me trying to pick it up. I call myself the Birdman of Clifton. I'm cheap.
But don't have SC tax supervisors always show losses on his farm. And then last year, he showed a gain. And their biggest thing was, now we got to pay this huge freaking bill. And I was saying, that's a good thing. That means you're making money. Well, but then again, this year, he showed a loss. So,
He's having fun losing money.
yeah, but you can only do it for so long. Again,
You can lose $1 to save a quarter. Does that make sense? Keith, come see me. For every dollar you give me, I'll give you back a quarter.
the name of the game is they still have, our $1 million earners still aren't sort of against making money because they're paying a heck of a lot more tax. If you're making $1 million, half of that's going to Uncle Sam. You still got the other half. I mean, that's the biggest thing. Make money. Make as much money as you can. When people think that, no, I should make less money. Well, heck, we're still having, say, at least half of this income is still going to us. So we're still paying bills.
So what you're doing, what people in the theater saying, you're not really scared of what you're saying.
No, you need to be aware of this is coming down. A lot of our people, when they're looking at, say, Schedule C, say they have a side business or a Schedule F and they're farming, you need to be aware that this is driving SE taxes. Don't think that you're just having to pay one tax here. No, you're bringing in another tax. Where most people, I would say probably 80% of our clients, they don't worry about this because they're W-2 people. They take it right out of their check. I mean, you're getting only a net check, and you're not really aware that you're paying Social Security and Medicare tax. But for you guys, you get one lump sum bill at the end. So that's where it's a little more noticeable to small business owners or small farmers.
I always tell people, the important number isn't whether you get back a refund or the old one. The important number is to look at how much tax you get. It's probably your biggest bill of the year, but only because it helps out that you go along that you don't realize how much you have to actually pay. But you really should look at it. That's a big number sometimes. I mean, we got a lot of people, they're paying $25,000, $30,000 now. Throughout the year, they didn't buy one thing that was $25,000 or $30,000. They paid this at the end, but because Uncle Sam or the employer had held that money out, they said, how much money am I getting back? I hate to pay them. I thought to myself, you paid them. They just, you paid it earlier, Who's getting food?
It's really a seesaw. Either you pay it throughout the year or you're paying a bill at the end of the year. But that's where, being classified a farmer, we don't get hit with the bill that we really don't want to have, and that's interest and penalties. So we want to make sure we always stay away from interest and penalties because that isn't necessary that you have to pay.
I got a question.
Yeah.
Can you, if you incorporate your business or get some type of LLC or something, would that minimize your taxes?
It can.
But you still need to show it's not feasible that you're working for all this money for free. You still got to transfer it over to your personal side anyway. Either through rents, W-2s. I mean, W-2, either you set up a separate corporation that handles the farming business, but how the heck do you get the money back to you? All that money's tied up in that corporation possibly. So you still got to give yourself a possible W-2, and that way you're paying Social Security and Medicare tax. Our biggest thing on corporations are, before you even start thinking about that, make sure that you're making money. We've had a couple people, even before they started the business, incorporated, either for tax deferred reasons or for liability concerns.
Credit, yeah.
Yeah, or for liability concerns. But when we've gone over this for a couple of years, they hardly do any activity in that corporation. So what the heck's the point of doing it? I mean, it costs you money. Number one, it's a separate tax return. Number two, to set up the whole thing. Number three, it's $100 for a franchise fee that the state of Illinois charges.
The LLC is $250.
Yeah.
So make sure before you even think about corporations that it's feasible, that you're making money, that you'll actually be able to make money if you do a corporation.
We generally say walk before you run.
Right.
If you got a good thing that's going to make money, and if you're going to go to every corporation starts out as a C corporation. And I think everyone starts out as a bull, and then you make it into a steer later on, because you make it into an S corporation, you file a form within 75 days. But they all start out as C corporation. The biggest problem with the C, if they have a loss, that doesn't carry down to your personal return. And so it stays in that entity until we actually have a gain later on. Now, if you go into a business that never had a gain, we have a loss and lost money out there, and yet we can't deduct it on the personal return. The sub S does that, but the other thing is, if we have big gains down the line, that still flows down to your personal return because of the flow through. You don't pay tax at the sub S level. It all comes down to your personal return. So you really haven't gained too much there because you're still putting on all the income. The only thing that you can do is you can play some games with the rent and the money coming out to your income distribution, as they call it, but they're going to crack down on that. But we can get by with paying a little bit less Social Security tax. But that's where the savings is in a sub S, you know. So there is no free lunch. And then the person's we go on to the next deal and they say, well, I'm not making too much of it, I just won't report it. And the problem gets down to is the government isn't stupid. Number one, if you use a credit card machine or something, they have a deal they call a 1099K, and that's like a bird dog coming out to it and spotting the bedroom for you. They're going to send you a paper that says, this guy is running a credit card machine, and yet he's not showing any business on his return. Now, that's a little suspicious. Send him a letter and let's find out what's going on. They're not stupid, you know.
And then if you start buying new vehicles or new houses with cash, and they wonder, well, you know, you've shown losses all this time. Bam, they know. So everything has to look reasonable for this. But I mean, if we're looking at, what do we have? Maybe 3, 4 farm corporations?
Yeah.
I mean, that's about a dead limit. Most of this is done on the individual return. So I would think twice before you want to think about incorporating. And
It's got to place it. If you got enough money on the side that you can leave, see, where the benefit of the corporation comes in, the first $50,000 of net profit on a C corporation is taxed at 15 cents. On your personal return, you get up to $72,000 of net taxable income before you get above the 15%. So if you take that 50 plus that, you got 122 at the 50. But you've got to be able to live where you can leave money in the corporation. If you need all that money to come on over to live off of, you're not really having any profit left over here. And so you end up paying, you don't still have only the $72,000 to 15% because all the money's being switched over here. So if we can leave $50,000 into the corporation and pay 15 cents, and then we come on over and have enough other money that we take out over 72,000, then we got a lot of money being taxed at the lower rate. That helps us. But if you can't do that, then it takes away a lot of the perks.
So then after 10 years, you left all that money in the C corporation?
Yeah. And now you got.
How do you get it out?
Well, the biggest thing is, you know, you want to take the rules of 72, which you take the interest rate into the number 72. So if we get, say, 4 or 5% interest on the money, every 18 years, the money doubles. So say we leave the money in there for 18 years, and we take the money out, we pay tax at that point. Most tax-saving devices, you don't save the tax. You keep their hands off the money a little longer. And so, but the deal is if you held on to that money for 18 years, at that point, instead of owing them, say, $10,000, you owe them $10,000 over here, but you made enough off the interest on that $10,000 that you didn't give them before, that you give them their 10, that you got money left over. The idea is to keep their hands off as long as possible. It's deferment of the tax.
Well, I mean, it's a whole different subject if you're talking about how to resolve it.
But there's ways of getting around that, not resolve.
Well, right, but
There's ways of getting around that too. We take a little bit more deductions. You know, there's ways of playing with it.
Here's a question back here.
yeah.
It's regarding the incorporation. You said, I want to know about like tax exempt people or charitable people. How do you?
Nonprofits. They've got like about a 35-page book. They're supposed to be trying to cut that down. Right now, it takes a lot to apply for those. And as you can see in the news lately, the IRS depends on who you is, whether they accept it or not. You know, the Internal Revenue Service took the blindfold off of where they're supposed to treat us all the same. And right now, they're using that for political means. It sounds like anyhow. But as far as a not-for-profit, you have to have a good reason of where that money's going to. Just the fact that you have a loss, you have to give reason to where you're going to use that money to benefit other people and stuff like this. So, it's like I say, it's about a 30 or 35-page book to fill out to even apply for not-for-profit.
There's a couple of them that have them already, a few people in here have nonprofits already, and they farm,
Yeah.
and then they're farming under those, nonprofit
Yeah,
status.
but you have to give the money away, which, again, that's worse than paying the tax, isn't it?
That's what he always says about.
I mean, if I had a choice between either keeping the money myself and giving Uncle Sam 25% of it, or give it all away to charity,
Well, you are a charity, but it is a charity. It is a charity.
Right.
yeah.
So they're
Well, I
planning.
get that, but you got, when the money comes on in, you got to dispose of that money. You can't just build that money up. That charity has to have a reason
You
for
can
being.
invest in your own, you can invest in your own charitable organization.
Yeah.
So that's,
But it's a charitable organization, but that charity has to have a purpose for being a charity. Where are you going to do with the money? What are you going to? You're going to have to give away that profit. You can't be a money-making proposition and call yourself a charity. It doesn't make sense, right? You're contradicting yourself.
Right.
You know, so that money you have to have a purpose. They want to know where that money was spent and how did you dispose of the money. If you start building assets
Right.
down that, even in that charity, you have to have a reason. Why am I a charity? Where am I going to give my money to? And then you have to tell them where you're giving that money away or whatever's left over. And whatever you're doing, if you're not making any money at it, then, even if you take some money out to pay yourself, that's taxable income to you.
Right.
So,
I'm sorry to stay on corporations, but I always looked at them as asset protection. How does a small farmer protect their assets?
number one, liability insurance. If you take an umbrella out, I call it screw-up insurance. You take out screw-up insurance, and you run into somebody or something like this, they don't take all your assets. They always told me to take more liability insurance than what you're worth, because if they have a choice between the two bags, they won't go with the bigger bag, and make sure that the insurance company is one with the bigger bag. Because number one, you get somebody to fight with you, because they're going to be pretty tenacious, not to let their money out too. So the guy has to prove his case pretty good. And I'd rather have a big company back of me than myself.
No, he always says, always keep your major assets, so like land, buildings, that type of stuff outside. Always keep that in your individual name. Because if you do have a corporation, that's a cheap way to get money back to you. You just call it rent from the corporation to you, not SC taxable. So then we get away from the SC tax, it's just taxing your ordinary income.
But the other thing is, on a C corporation, there is no capital gains rates. It's all straight taxable income. And so that taxable income can go up to like 45% versus it's locked in at 15% maximum as far as a capital gains rate.
So really, the last slide here is where you consider a farmer, where 2/3 of your gross income has to come from farming or fishing activities. If it is, and you haven't paid in 90% of your tax, and we owe them money, then you're actually due by March 1st. Again, this is one of where most people are due by April 15th. Farmers are due by March 1st if you're classified as a farmer, because they don't want you holding on to that big bill of money that's not collecting interest until April 15th. So you got to pay your total tax due by March 1st on this.